In specific, one of the vehicles I'd like to talk about is mutual fund because it's very popular, yet subject to a lot of misinterpretation. As we discussed earlier, mutual fund is a vehicle which can carry equity underneath it. So the way it is organized is that a mutual fund has a set of competent people, really portfolio managers, who accumulate a number of shares based on a theme and divide those shares into equitable units, which are then sold to people like us who are the consumers. The idea is, instead of us buying directly shares in the market and subjecting ourselves to the risk, you have a dedicated portfolio manager in a mutual fund who does that for you. And presumably, by the fact that he is trained to do this or is trained in this area, and the fact that she spends all her time doing this should yield better results than if we did this in the time we find apart from pursuing our own career and work. Mutual fund can have number of themes. So one of the theme could be it's a mutual fund which has an accumulation of funds which are all blue chip, top companies. Or you could have a mutual fund with a theme of small and medium enterprises. It could be focused on a particular segment, a financial segment or telecommunication segment. It could be focused on geographies, overseas market, and so on. So there are various themes. It depends on how you define what that particular mutual fund should be, and then you have to stick to that as per the regulation. There are a number of considerations and distinctions in a mutual fund that you must know. Fundamentally, there are two types of funds within mutual fund. One is passive and active. A passive fund is one where the portfolio manager actively pursues buying and selling of shares, creating the composition underlying the units which is sold to you, to make sure shares are bought when they are low, sold when they are high, and the whole idea is to maximize return. And it works pretty well, especially when the market is going up. The portfolio manager has a great opportunity to show her capability in doing this. On the other hand, the passively managed mutual fund is one where it comprises of a set of equity shares weighted to mimic the index, like a Nifty index, a Standard & Poor index, or a NASDAQ index, and so on. And therefore, as the index moves up and down, the mutual fund reflects that. The difference is substantial. In passive fund, the cost of the fund is very low. You don't need a portfolio manager to focus on it, buy and sell. It's almost formulaic. It is driven by a computer program. On the other hand, in an actively managed fund, judgment is applied. There is a portfolio manager, there are analysts, and so on. So the cost of the fund when it is active is substantially higher than when it is passive. The other categorization is in terms of hybrid funds. So sometimes mutual funds are not just equity or just debt. You can have a mix of it, 60% equity, 40% debt, or the reverse of it. The idea is to balance risk and reward for people who like a certain amount of balance. It could also be for tax consideration, depending on how much of it is debt or equity. It will fall under the purview of one of these asset classes from a tax point of view, and you could save tax. Again, a detail which you will be very difficult for you to ascertain, but is very good for an investment advisor to decide and tell you. The third aspect, which is very important, is expense ratio, which is the cost of running that mutual fund. That is the cost of the entire organization which runs it, the portfolio manager, the analysts and others, as well as the administrative costs required to sustain the fiduciary responsibilities involved, and therefore the cost of filing, the cost of reporting, and all of that. And this can be substantial. So typically it could, for example, be 2% of the overall value of the fund. And incidentally, the overall value of the fund divided by the total units sold is called NAV, net asset value. So a mutual fund, unlike a stock or a share, does not have a minute by minute value of it, but at the end of every day by 3 o'clock or 4 o'clock in the evening, it is mandatory for the mutual fund organization to let the users know, let the buyers and sellers know what is the net asset value of that particular mutual fund. But back to expense ratios. So if an expense ratio is 2% of the total asset value of the mutual fund, and the mutual fund on a not so great year returns 5%, effectively 40% of that 5% has been eroded by costs, and therefore you're left with only 3%. Therefore, on the overall asset value of the mutual fund, 2% may seem very trivial, but on the profit or the return it makes, 2% can be very, very significant. Even if the return is 10%, a 2% cost means 8% is your net return on that particular mutual fund, and therefore you must be very careful to determine what is the cost of the fund before you invest it. Then you have a distinction of a regular fund versus a direct fund. If you go to the fund directly, the mutual fund, and buy it from its portal or website, you save the distribution cost involved. On the other hand, if you buy it from a brokerage house or a distributor of the mutual fund, which could be a bank, which could be a discount brokerage house or anybody else, then there is a load called the front-end load, which is the cost of distribution. And that could be significant. Likewise, there is a cost at the end, at the tail end of the, when you sell the mutual fund. That diminishes the longer you hold the mutual fund, but is substantial if you sell it as soon as you buy it. And these all make an impact on your net return, because you might hold the fund for a long period of time, and these have an impact on the return percentage. And of course, we've all heard of SIP, systematic investment plan versus lump sum investment. So you could say that I have at the end of my year a bonus which I've received from my company, and I put that entire thing into the mutual fund. And then there is the SIP versus lump sum. You could get a bonus at the end of the year and put that entire money into a mutual fund, which would mean a lump sum investment in a mutual fund. On the other hand, you want to follow the discipline of saving every month, and therefore you say systematically every month a certain amount of kitty from my salary account will go into a mutual fund. That's called a systematic investment plan. And these are personal preferences depending on your cash flow requirement, depending on how your salary is structured, and depending on how your expense and life is structured, and you might choose to follow one of them. ETFs, exchange traded fund, is a sort of a near relation of mutual fund, and there are nuances which makes it different. ETF potentially can be more tax efficient. Second, ETF is designed in such a way that, unlike in mutual fund where you have a net asset value declared at the end of the day, and during the day you don't know what its value is, ETF behaves exactly like a stock. At any point in time, there is a price for it, so you can sell at that price, somebody else can buy it, and so transactions can take place. And ETFs tend to be generally used for commodities, and of course it can be used for equity and sometimes even for debt. But the distinctions are small, and again it is an advisor who can advise you on whether you want to go in for a mutual fund or you want to go to an ETF. These are best left to the investment advisor, as these are very nuanced and may not be worth discussing at this level at this point in time.
Thank you for watching. If you want to dive deeper into this topic and stay updated on our latest content, be sure to subscribe now. And if you found this video helpful, don't hesitate to share it with someone you know. Let's spread the knowledge and the fun together.